If you follow any type of business news, then you certainly have heard about big mergers and acquisitions from time to time. A recent one to note is the one between Spirit and JetBlue. Now that one actually got denied.
The DOJ victorious. A judge has decided this merger will not go through.
Regulatory issues are the reason why that deal failed. But that's a huge deal. Most deals in terms of numbers happen in the middle market and even the lower middle market. In those size of deals, the FTC or regulatory issues typically aren't a big deal and aren't a reason why an M&A deal would fail. So that begs the question, why do most M&A deals in the middle market, lower middle market fail? Well, stay tuned and I'll give you 4 reasons from my 15 years of experience in private equity as to why lower middle market deals fail. Now, this isn't the biggest issue. I'll save that one for last. But one of the key reasons why an M&A deal might fail, especially in the lower middle market, is because of tax or other liabilities that are uncovered during diligence. Now, what do I mean by that specifically? One of the companies that we were looking at, the owner had all sorts of exotic race cars, and the guy was living a very lavish lifestyle. And you know what? It was all being deducted on his business tax return. Where it ran into issues is that the seller wanted us to buy the business via a stock purchase instead of an asset purchase. In our view, we felt that with an asset purchase, we were going to be much better protected against any potential income tax liability if the company were to get audited than if it were a stock purchase. Now, from the seller's perspective, the stock purchase was much more attractive because he had to pay less in taxes. That was the reason why the deal failed, because ultimately we didn't agree on a valuation given that there was this looming tax liability on the business. The second issue is also related to financials, and it's what I would call creative accounting. You oftentimes will talk to a company and they'll tell us that their expected EBITDA for the year is going to be, let's just say 4 million. And you look at it and you think, great. However, once you start to get in there, you realize that perhaps their view of what revenue should be recognized is different than what your view of revenue that should be recognized. An example of this was a company that dealt with a certain type of insurance policy that was geared towards highly compensated employees. Now, this company had a great history of, once they wrote a policy for the person who the policy was in place for, to renew that year after year. So even though they had a great track record of that policy staying in place, well, when you looked at their financial statements, they actually counted those renewals as revenue in the current period. We weren't exactly okay with that. There's no way I'm getting comfortable with counting that as current revenue and dropping down to the bottom line. Another example deals with how the company would record invoices and whatnot. This specifically relates to payables, actually. So the company was on a cash basis accounting system, which is perfectly fine. However, what the company did is that whenever they would get an invoice from a vendor, they wouldn't enter it into their accounting system until they actually paid it. We were looking at financials and we thought that, EBITDA was, let's call it 3 million. Well, actually EBITDA wasn't 3 million because they had $500,000 worth of invoices that they had not entered. So it was a situation where the valuation that we had contemplated for this deal was way too high, given that they had underreported expenses by that $500,000. Another reason why deals fail is because of the sell-side advisor. There is a great deal of variability among them. What was happening on one particular deal, though, is that we would get financials, and after further investigation and whatnot, what we realized is that the financials as reported by the company from the gross profit line to the net income line were estimates based off what this sell-side advisor thought was appropriate for the industry. And the folks on our side of the deal were just kind of scratching our heads as to how that person thought that was even within the realm of being reasonable and whatnot. Once we got the actual financials, not just to the gross profit line, but all the way to the net income line, they were way different than what the sell-side advisor had presented. And we asked them, it's like, wait a minute, you represented that net income was, $5 million bucks, really it's only $3 million. What gives here? It's like, well, those operating expenses, they shouldn't be that high. That was a major issue on that deal, and it really, cut into the credibility not only of the sell-side advisor, but also had to question a little bit about the seller there as well. Now, finally, we move on to the biggest reason why deals fail. The performance during the due diligence period drops off. Prior to entering into an LOI, you'll have been looking at financials and you'll have comfort around what you expect the trailing 12 months EBITDA to be as of a particular month. So let's say that TTM EBITDA as of November is, $5 million bucks. Great. We would make an offer. Let's just do 5 million of EBITDA, 5x multiple. Here's an offer for 25 million bucks. What we've seen happen on certain deals is after we sign the LOI, which takes some time to negotiate and whatnot, EBITDA might drop off by 5, 10%, sometimes even more. So when you started the deal, you might have valued it at 25 million bucks, but if EBITDA drops by 10, 15%, you're looking at a pretty big gap. In this example, let's just say the EBITDA drops by $500,000. Well, 5 times $500,000 is $2.5 million worth of value. I'm not going to sit here and say that if that were to happen, we are absolutely going to walk away. However, it's definitely going to force us to take a bit of a pause. We want to understand why the performance has dropped off. It really just opens up a can of worms, and even with the best of intentions on the part of the seller and the buyer, a lot of times, if performance drops off in a material way, kills the deal. Now, in a later video, I will talk about what to do if a deal implodes. But after hearing the 4 reasons as to why a deal in the lower middle market fails, what do you think? Have you experienced these firsthand, either as a buyer, a seller, or an intermediary? I'd love to hear what you think. Leave me a comment or send me an email. Thanks for watching.